If you're thinking about dedicating your life to something, you have to have visualization of what you want to be doing. The only thing you do is what everybody else is doing. You won't be able to create something that's unique.
Most people, even outside of finance, have heard of Blackstone. It's the private equity firm every finance bro wants to work for, and it's quietly built a real estate empire that's been criticized for single-handedly pushing up housing prices and crushing the American dream. But how did a kid from a suburb in Philadelphia with zero family connections to high finance end up building the most powerful asset management firm on the planet? Today, we break down how one man unapologetically built Blackstone with endless ambition into a firm that today manages over $1 trillion. This is the story of Stephen A. Schwarzman. Schwarzman is a builder. He built deals, he built brands, he built institutions, and he built all of them at a scale that most people in general can't even imagine. Throughout this video, you'll learn how Schwarzman built his edge, how he's always been one step ahead in private equity, in real estate, and now in AI infrastructure. Schwarzman's story is one of ambition. Raw, unapologetic, and sometimes downright shameless ambition. His story involves legendary deal makers, sharp business strategy, and even Gwen Stefani. And you'll see what happens when you combine endless ambition with institutional thinking at the highest level. But before we get started, if you're watching documentaries about finance, you're probably serious about your career. And if so, you know that leveraging AI is quickly becoming the most in-demand skill sought by the world's top employers. The only problem is that keeping up with AI is overwhelming, and it's often hard to know how to build the relevant skills. And that's where the certificate program from Columbia Business School and Wall Street Prep comes in, that's focused on AI for business and finance. Students, including financial analysts and portfolio managers, take this 8-week-long course to learn about core AI concepts like LLMs and machine learning, get hands-on experience using Python to solve business problems, and see how top firms use AI in FP&A, risk investment management, and more. You'll be taught by world-class Columbia professors and also have a chance to learn from a ton of great guest speakers who work at firms like Perplexity, OpenAI, Google, and more. There's truly no program currently like this, and if you're interested, be sure to use my code rareliquid to get up to $500 off, and I'll leave information for this program in this video's description. Schwarzman was born on Valentine's Day 1947 in Philadelphia, Pennsylvania, and grew up in a comfortable suburb called Huntington Valley. His father ran a store called Schwarzman's Curtains and Linens, and from a very early age, Schwarzman showed signs of ambition and business acumen that were far beyond his years. He started working at the family store at the age of 10 and had already been selling candy bars and light bulbs door to door. At the age of 14, he encouraged his Wharton-educated father to expand their family store into a national chain like Sears, but his father shot the idea down cold, which was something Schwarzman could never understand even decades later. Undeterred, Schwarzman took matters into his own hands and started a lawn mowing business, hiring his younger twin brothers to do the actual mowing while he brought in clients and managed the operation, so even as a kid, he was deal making. In high school, he ran track, was elected as senior class president, and ended up going to Yale after being waitlisted by his dream school, which of course was Harvard. Now, unlike most people who are sane and normal, this prompted him to find the number of Harvard's dean of admissions to tell them that they were making a mistake because he was going to be very successful. This, of course, amounts to nothing, but Schwarzman does have the last laugh in the end, as a Harvard dean would write to him decades later that they did make an error. And so one thing was clear from the jump. Schwarzman was never content to just play the cards he was given. He always wanted to turn his luck into something bigger, always chase the next big opportunity, and always wanted to mold the world not into how it was, but how he saw it should be. During his time at Yale, Schwarzman was a member of Skull and Bones, the secret honor society that some say currently influences modern-day global policy from the shadows. At Skull and Bones, Schwarzman rubbed shoulders with George W. Bush, who was 1 year ahead of him. And to show you how secretive this club is, in Bush's autobiography, he says a line that is the famous template for how bonesmen handle being asked about what happens inside the org. In my senior year, I joined Skull and Bones, a secret society, so secret I can't say anything more. He also continued to mold the world to his desires. In the 60s, Yale was an all-male school that had a 270-year-old rule that forbade women from staying overnight in the dorm room. So he recruits 11 students to hand out surveys to the entire undergraduate body, and nearly 100% were against the rule. He took this result to the Yale Daily News, and 3 days after the story ran, the rule was abolished because the university didn't want to fight it. So if you happen to be a guy watching this and you go to Yale, Schwarzman says you're welcome. After graduating in 1969, Schwarzman's first job is at Donaldson Lufkin Jenrette, and what's more notable than the job itself was how he negotiated his offer. Schwarzman was offered a standard compensation package, but told the firm's co-founder Donaldson that he wouldn't take the job unless he was paid $10,500 because another student graduating from Yale was making $10,000 and he wanted to be the highest paid person in his class. Donaldson replied that he didn't care and that he shouldn't be paying Schwarzman anything at all, but 2 days later called back and offered the requested $10,500.
This is like $10,000. He said, by the way, in case you haven't realized it, you're basically worthless. I said, yes, I'm aware of that, but I still want $10,500. And he said, are you not going to take this job at 10? I said, no, I'm not going to take it.
Then, in order to avoid the draft during the Vietnam War, Schwarzman signs up for the Army Reserves and notices that his squad was being underfed. The colonel had told new recruits on day one that if anything was wrong, to come see him, so Schwarzman does. Afterwards, Schwarzman goes to Harvard Business School, which he hates because he finds the level of quality to be lower than even his high school. So of course, he sets up a meeting with Dean Larry Foraker, who during their meeting says, "Mr. Schwarzman, are you always such a misfit?" Clearly, you see the pattern. Schwarzman identifies something he doesn't like, goes directly to the top of the food chain and tells him they're wrong. He's done this to his father at Yale, in the Army, at Harvard, and this attitude gets humbled real quick at his next firm, Lehman Brothers. You may have heard of Lehman Brothers as the investment bank that collapsed in 2008, but in 1972 when Schwarzman joined, Lehman was basically the Goldman Sachs of its time. Schwarzman's first year as a banker was brutal, and at one point he was yelled at by senior partner Lou Glucksman for a typo. And having been in banking myself, I've never come across yelling while at JP Morgan, but I've heard banking culture used to be a lot rougher in the past, so I'm sure Schwarzman was chewed out. For once, he can't just go to someone like the CEO of Lehman, he has to suck it up like all junior bankers do, and over time quickly rises up the ranks. In 1978, at just 31 years old, he executes on Tropicana's $488 million sale to Beatrice Foods, the biggest merger of the year. That deal puts his name on the map, and the morning it was announced, Schwarzman gets a call from Felix Rohatyn, who at that time was a legendary banker at Lazard who saved New York from bankruptcy. He tells Steven, "Congratulations, you've entered the world of the grown-ups," and that he needs to speak out and be brave, which obviously was music to Schwarzman's ears. Schwarzman becomes Lehman's youngest managing director that year and head of global M&A at just 31, which sounds great, but Lehman Brothers at this point was an absolute pressure cooker. Brutal internal politics, competing egos, and power plays. It was basically Succession, but in real life. A trader named Louis Glucksman, the same one who yelled at Schwarzman during his first year and was known for throwing his phone at office walls, staged what Lehman insiders called the Great War of 1983 to 1984. This period was a brutal power struggle between Lehman's traders and its advisory bankers. The traders were making more money than the bankers at the time, so Glucksman eventually got his way and forced Lehman's chairman and CEO, Pete Peterson, out. This saga was later chronicled in Ken Aletta's 1986 book, Great and Glory on Wall Street, The Fall of the House of Lehman, which became one of the defining Wall Street books of the decade. When Pete left, many bankers followed suit, which led to a talent exodus at Lehman, and Glucksman ran into trouble after traders made some wrong bets. And so, in 1984, Lehman is forced to sell to American Express for $360 million, and Schwarzman himself is the one who runs the sale. Not born to work for a credit card company, Schwarzman and Peterson start hashing out a plan to build something on their own. And so in 1985, at the age of 38 and 58 respectively, with $400,000 in seed capital, one of the most powerful financial institutions in the world is born, but not without a rocky start. I've always wondered how Blackstone got its name, and turns out that Blackstone is a nod to each founder. Schwarz means black in German, and Peter means stone in Greek. Another thing most people don't know is that Blackstone version 1 was not the private equity giant you know today. Blackstone actually started as an M&A investment bank, and Peterson's connections even landed them CSX's $1 billion acquisition of Sealand in their first year. But the duo actually planned to enter the PE industry from the get-go. They had already seen the ceiling of investment banking firsthand and how advisory fees were fundamentally linear. You advise a deal, collect the fee, and move on. There's no compounding, no ownership, and no real upside beyond that fee.
At that point, the private equity business was pretty much of a no-brainer. Prices were low, capital was available, weren't many people in it. That was a way of also raising management fees at that time because you wanted predictable income. I'm always in the risk minimization business.
Private equity, which was a new bustling industry in the 1980s, flipped that model entirely. Instead of facilitating deals for others, you owned the companies yourself, and the fund structure of management fees plus 20% carried interest on profits meant that as Blackstone grew its AUM, the economics scaled exponentially in a way that an investment bank never could. Schwarzman also saw something else, an industry still in its infancy, with a real first mover advantage available to anyone bold enough to build a top-tier private equity franchise early. But first came the rejection tour. Schwarzman and Peterson met with 488 prospective investors, but only 33 invested, a big ego hit to two hotshot senior bankers, with Schwarzman saying the rejections were horrible and humbling. With a target of $1 billion, after 6 months of fundraising, they only managed to raise $75 million from New York Life and MetLife, but both are contingent on Blackstone raising $500 million. And so then comes the tuna sandwich story. In the 1980s, Prudential was the #1 financier of leveraged buyouts, and so Schwarzman and Peterson saved them as one of the last meetings on the list, since at that point, their pitch would be perfect. Schwarzman wasn't optimistic due to all their failed pitches, and as he was pitching, Prudential's vice chairman Garnett Keith was eating a tuna sandwich. He puts down the last quarter of his sandwich, stopped chewing, and said casually, "You know, that's interesting. Put me down for 100. Schwarzman later told institutional investor, "There was nothing legal I wouldn't have done for that 100 million. If Prudential thought it was a good idea to invest with us, others would follow. I wanted to reach over and snatch away the last quarter of that sandwich to make sure Garnett didn't choke on it."
And I'm busy pitching this private equity fund, and you can share part of our advisory profits as a merchant bank. And he keeps chewing, and his Adam's apples going up and down, and I keep doing my thing. Finishes the first half of the sandwich, gets through the other half, halfway, and he looks over at me and he says, "I think that's a good idea. Put me down for 100.
That was the turning point, and on October 15th, 1987, Blackstone raised $850 million just 4 days before Black Monday, when the Dow plummeted by 22.6% in a single day. If Blackstone had tried 5 days later, the fund wouldn't have closed, but it was also the perfect time to have cash to invest in distressed assets. Even still, that wouldn't be enough to prevent the first of multiple near deaths of Blackstone. In 1988, Blackstone closed its first LBO, the acquisition of Transtar, the transport division of USX, the descendant of Andrew Carnegie's US Steel, and the structure of the deal was audacious for a firm this young. Blackstone paid $650 million for 51% of the business after putting in just $13.4 million of their own equity. USX contributed $125 million in vendor financing, and Chemical Bank lent the rest. This was the private equity model in its purest form. Enormous leverage, minimal equity, and the potential for extraordinary returns if the business performs and you can pay down the debt. If you look at it, the math is almost cartoonish. $13.4 million in equity to control a $650 million asset. Within 2 years, Blackstone had made a 4 times return on their investment. By the time the last piece of equity was sold 16 years later, the return was 26x, turning $13.4 million to $350 million by 2003 on their very first deal.
What's the best deal you've ever made?
Jeez. Well, I guess everybody's got a good story in life. We could come up with at least one. I guess the best was really one of our first. It was buying a company that we renamed Transtar, which were a bunch of railroads and barge lines owned by United States Steel Company that we bought when they were having a strike. And it was done in the 1980s, and we leveraged it. Must have been, I don't know, a lot, whether it was 8 to 1. And by the time we were finished with the deal, we
$1 of yours and $8 of theirs, and you had these barges.
And we had railroads basically, and we made 24 times our money. So
24 times your money.
That was a good deal.
Transtar made Schwarzman look like a genius, but the year after, in 1989, he also made what was about to be one of his worst decisions of his career. Blackstone was looking at its third major investment, a steel distribution company called Edgecombe Metals. The deal was brought to him by a new partner Schwarzman had hired with an asking price of $330 million. Now on paper, the deal looked great. Edgecombe's earnings were rising, and the partner who pitched it knew the company inside and out. But another Blackstone partner, David Stockman, thought Edgecombe was a ticking time bomb. Stockman argued that the company's rising earnings weren't operating profits, but instead just gains on the value of their steel sitting in their warehouses. And if steel prices were to drop, earnings would vanish, and the company would go bust. And so Schwarzman had two senior partners telling him completely opposite things, and coming off a hot TransStar deal, he later recalled, "I thought I was King Solomon at the age of 38. Guess what? I wasn't."
We're just sitting in front of my desk. I thought I was King Solomon at the age of 38. Guess what? I wasn't.
He greenlit the deal, steel prices crashed almost immediately, and Blackstone lost essentially all of its equity investment in Edgecombe, leading to the worst moment of Schwarzman's career. A very angry investor in Blackstone's first fund summons Schwarzman to his office in Nyack, New York, and what happens next is something Schwarzman has talked about for 35 years. The investors screamed at him for what felt like an hour but was actually just 5 minutes. He told Schwarzman he was one of the dumbest people he'd ever met, and Schwarzman just sat there and took it because he knew the guy was right. As he put it, "I almost wanted to cry actually because he was right. It was my decision, it was my fault."
I walked into this office and the guy asked me to sit at the solo chair in front of his desk, and he started screaming at me. The stupidest thing he's ever done in his career is trust me, give me money. And it seemed to go on forever. And I was sitting in this hard chair and my face started getting redder and I realized I was going to start crying.
Those 5 minutes also basically reprogrammed how Blackstone makes investment decisions. Schwarzman walked out of that meeting and built what's now one of the most rigorous investment committee processes in private equity. Every deal gets debated by the senior team, every major risk gets scored and probability weighted, and dissent gets institutionalized instead of punished. But Edgecombe wasn't even Schwarzman's most expensive mistake of this era. That title goes to a guy named Larry Fink. In 1988, Fink had just been pushed out by First Boston after a $100 million loss on mortgage securities, and he approached Schwarzman with an idea, a fixed income investment firm built on risk management technology. Schwarzman gave him a $5 million line of credit and 50% ownership of a new venture inside Blackstone called Blackstone Financial Management, and within 5 years, that business had $20 billion in assets under management. In 1994, Schwarzman and Fink start fighting over how to dilute the partners to attract new talent, and the relationship fell apart. Blackstone sold its 36% stake to PNC Bank for $240 million, and that business eventually became BlackRock, which today is the largest asset manager in the world with $14 trillion in AUM today, and Schwarzman has understandably called this his worst business decision ever. Just to put it in perspective, between 1995 and 2014 alone, PNC reported $12 billion in pre-tax revenues and capital gains from BlackRock, 50 times what they paid for it. And BlackRock has only gotten bigger ever since. By the mid-1990s, Schwarzman had taken 2 gut-wrenchingly painful punches, but he also built the muscle that would turn him into the king of private equity. In just over a decade, Blackstone becomes a terrifying compounding machine, growing from $5 billion in AUM in 1995 to $88 billion in 2007 as Blackstone grew into a multi-asset investment empire. But what may surprise you is that Blackstone's growth is rooted not in private equity, but real estate. In 1991 and 92, the US was in the middle of a savings and loan crisis. Houses and assets were being seized left and right, and the real estate market was a complete disaster, which meant distressed opportunities. Despite not knowing much about real estate, Schwarzman hires John Schreiber and makes him co-founder of Blackstone Real Estate, and also hires a 22-year-old Wharton grad named Jonathan Gray, who today is president and CEO of Blackstone. Together, the two would oversee $40 billion of real estate investments over the next 2 decades and turn Blackstone into one of the largest commercial real estate owners in the world. Through the 90s, Blackstone also expanded aggressively across asset classes, funds of funds, credit, advisory. Schwarzman wanted Blackstone to be an institution, not a one-trick pony. And Peterson, now much older, transitioned out and retired, making Schwarzman the undisputed center of gravity at the firm.
I'll do private equity because I always worried that if you stay in one business, if anything goes wrong with it, then that's not so good.
The fundraising momentum was now undeniable. The 488 investors who previously mostly said no to Fund 1 were now being replaced by a queue of institutions eager to get in. In 1993, Blackstone's second PE fund closed at $1.3 billion and returned 38%. In 97, the third fund more than tripled that, closing at $4 billion. And in 2002, $6.5 billion, the largest ever by a PE fund in a challenging post-dot-com bubble time when few could raise capital at all, and ultimately returning a Blackstone best ever 36% IRR. By 2006, Blackstone was managing over $80 billion across private equity, real estate, hedge funds, credit, and advisory, but Schwarzman's spidey senses were also starting to tingle. He started getting nervous about the market as he started asking everyone he ran into, waiters, gas station attendants, what they were seeing in the economy, and real signs of a slowdown started showing up. And so Blackstone began selling, unloading 80% of its private equity portfolio at peak prices before the Great Recession. And so let's talk about 2007 when everything exploded at once. By the mid-2000s, Schwarzman was fully in his element, telling the Wall Street Journal that when he pursued deals, he wanted to inflict pain on his rivals and that he wants war, not a series of skirmishes. The man was clearly feeling himself. In February 2007, he throws himself a 60th birthday party that's considered to be the last great party of Wall Street's Gilded Age. He spends $5 million for 500 guests, including Trump, Jamie Dimon, Lloyd Blankfein, and pays Rod Stewart alone $1 million to perform. Just 4 days earlier, Blackstone had closed a $39 billion acquisition of Equity Office Properties, EOP, the largest LBO in history at that point, with massive leverage, as Blackstone only put up $3.2 billion of their own equity. But the real genius was what happened right after closing. Blackstone sold off 2/3 of the portfolio, unloading $27 billion of EOP's assets by the end of 2007, including 8 buildings to a guy named Harry Macklowe for $7 billion. Macklowe got absolutely destroyed when the Great Recession hit, while Blackstone walked away with a cool $7.5 billion profit. In June 2007, Blackstone takes itself public at $31 per share, raising $4 billion, which at the time was the largest IPO in 5 years and the second private equity firm to ever go public. Schwarzman pocketed nearly $700 million from selling his stake while still owning 24% of the company. Then just 1 month later in July, Blackstone buys Hilton Hotels for $26 billion while putting up $5.6 billion in equity. This was the largest hotel acquisition in history, and as a fun fact, was internally codenamed Project Murphy after Eddie Murphy and Beverly Hills Cop, since Hilton was headquartered in Beverly Hills. The crazy year doesn't stop. Just weeks later in August, Blackstone closes its 5th PE fund at an insane $21.7 billion right before the financial crisis, which would end up generating a measly net IRR of 8%, obviously affected by the recession, which was not kind to Blackstone. By 2009, the stock was trading below $4, meaning 90% had been wiped out, and Schwarzman began to receive public criticism for cashing out while public investors held the bag, and for his unnecessarily lavish lifestyle, which doesn't stop, by the way. Later on his 70th birthday, Schwarzman would spend a reported $10 to $20 million gathering live camels, trapeze artists, and Gwen Stefani to sing him happy birthday. Anyway, in 2008, as the credit markets froze, every commentator who had warned that Blackstone buying Hilton at the top of the market was insane started running victory laps. But 3 things ended up saving Blackstone. First, they had pre-sold most of EOP at peak prices, so they weren't holding those properties when the real estate market collapsed. Second, when Hilton's debt traded down to 50 cents on the dollar, Blackstone went into the open market and bought back its own portfolio company's debt at a deep discount, then renegotiated with the other creditors to clean up Hilton's balance sheet. And third, in March 2008, 6 months before Lehman fell, Schwarzman acquired a credit shop called GSO Capital Partners that would become one of Blackstone's most profitable businesses. By the time the dust settled in 2009, the old Wall Street was dead, with nearly every bank in some serious pain. But Blackstone wasn't just alive, it was bigger and grew exponentially. From 2009 to 2019, Blackstone's AUM went from $98 to $571 billion as Schwarzman went on the most aggressive expansion run in modern finance history. In 2012, while the housing market was still bleeding, Blackstone made a contrarian bet. They created a company called Invitation Homes that bought single-family homes at distressed prices, fixed them up, and rented them out, a strategy no other fund was doing at their scale. From 2012 to 2016, Blackstone spent over $10 billion buying 50,000 homes across America, and at its peak was spending $150 million a week on houses. Critics were furious, arguing Blackstone was buying up America's neighborhoods, pricing ordinary families out of home ownership, and concentrating housing supply in the hands of a single private equity firm. Schwarzman argued that Blackstone was providing desperately needed rental housing when banks wouldn't lend and the housing market was broken. The debate continues to rage on, but either way, Blackstone IPO'd Invitation Homes in 2017, made a $7 billion profit, and basically invented the institutional single-family rental industry that so many funds now copy. In 2013, Blackstone also took a recovered Hilton public at a $20 billion valuation, making it the largest hospitality IPO ever, and by the time they fully exited in 2018, Hilton had generated $14 billion in total profit for Blackstone, crushing the 2000 narrative that Blackstone bought the top. That same year, Blackstone bought Credit Suisse's secondaries business called Strategic Partners with $9 billion in AUM. Secondaries is the business of buying existing private equity stakes from investors who want liquidity, and today, Strategic Partners is one of the largest secondaries platforms in the world. The biggest move of the 2010s and arguably the most important product Blackstone has ever created was Blackstone Real Estate Income Trust, or BREIT, which was launched in 2017. Before BREIT, private equity was an asset class only available to the extremely wealthy. BREIT packaged Blackstone's institutional quality real estate strategy and made it available to individual investors with as little as $2,500, and by 2021, BREIT alone had $94 billion in assets. The 2010s also saw John Gray quietly build Blackstone into the largest commercial real estate owner in the world. GE Capital's real estate portfolio for $23 billion, Stuyvesant Town in Manhattan for $5.3 billion, Biomed Realty for $8 billion, all owned by Blackstone. Schwarzman also started signing massive deals with insurance companies like AIG, Allstate, and Corebridge to manage their investment portfolios on a long-term basis. And insurance companies are basically the holy grail of asset management because they're locked up for decades. And by 2020, Blackstone was managing over $100 billion in insurance assets. By the end of 2019, Blackstone was managing $571 billion, and the 2007 designated villain had quietly built the most powerful and diversified alternative asset manager the world had ever seen. And of course, just as everything was firing on all cylinders, COVID hit. When COVID hit in March 2020, Blackstone was predicted to die again. The stock crashed 40% in a month, the economy was shutting down, and the firm owned tens of thousands of hotel rooms, office buildings, and restaurants that suddenly had no customers. But Schwarzman had spent the 2010s preparing for blood on the streets. Blackstone had over $150 billion in dry powder, so while everyone was selling, Blackstone was buying the dip. They bought Ancestry for $4.7 billion, a majority stake in Spanx, and bought into life sciences, industrial warehouses, and data centers. Then 2021 happened, which would be the most explosive year in Blackstone's history. AUM jumped from $618 billion to $881 billion in a single year, a 42% increase that was the fastest growth Blackstone had recorded in over a decade. Powell turned on the money printer, and the government was pumping trillions into the economy, causing asset prices to skyrocket. But by late 2022, the music started to slow. The Fed began raising interest rates aggressively, commercial real estate values started falling, and in November, the Wall Street Journal reported that BREIT was hitting its monthly redemption limit, which meant that some investors who wanted out couldn't get their money. Blackstone had to gate withdrawals, and the stock dropped almost 20% on the news. For about a year, BREIT became the center of every Wall Street debate. Bill Ackman publicly criticized Blackstone. Critics accused them of using questionable valuations to keep BREIT's reported returns high. Schwarzman defended the fund every chance he got, and by mid-2024, the redemption pressure had stabilized and BREIT was back to net inflows. Then in July 2023, Blackstone hits an insane milestone. $1 trillion in assets under management, and to put that into perspective, that's about 5% of US GDP. Over the past decade, Schwarzman also has been going full into legacy mode now that he has more money than he knows what to deal with. He donated $150 million to Yale, $350 million to MIT, and $188 million to Oxford, and notably only $5 million to Harvard. Students, faculty, and alumni of course revolt against the donations because of Blackstone's business practices. Seems one thing money can't buy him is love. Perhaps his biggest legacy play though is Schwarzman Scholars, which he launched in 2016 with $100 million. Some of my friends went through this program, and it's based in Tsinghua University in Beijing with the thesis that the 21st century would be defined by US-China relations. Today, Blackstone manages $1.3 trillion, which means it manages more money than the GDP of Switzerland and more than Sweden and Singapore combined. Schwarzman's net worth sits at a cool $44 billion, and the wildest part is that he's still the CEO. At 79 years old, while he has handed day-to-day leadership to John Gray, Schwarzman still goes into the office every day and sits on the investment committee for every major deal. His next big bet is on artificial intelligence infrastructure. Blackstone has become a major player in the data center and AI compute space, betting that the power grids, buildings, and land powering AI will define Blackstone's next decade. It's the classic Schwarzman playbook. Spot where the world is going before anyone else, build a platform, and deploy at scale. He did it in private equity, in real estate, and now AI. The same instinct as the 14-year-old who pitched his dad on turning his family store into a national chain is still there. At 14, he got shot down, but at 79, nobody tells Schwarzman no anymore. Stephen Schwarzman's story is one of limitless ambition. At Yale, he wanted to make more than anyone else in his graduating class. He put his name on deals, buildings, and universities. He had a $20 million birthday party at 70 years old. And he's built Blackstone into an empire larger than the GDP of developed countries. Most people in life are content with where they're at. They're not looking to become the greatest ever at something or build a company that will last generations, because the larger the dream, the larger the effort, sacrifices, and pain. So if you take one thing away from Schwarzman's story, maybe it should be a question. What's your level of ambition? And is it something that's pushing you forward or holding you back? Alright, so that concludes the story of Schwarzman. Hope you enjoyed the video and learned a lot. And if by chance you're watching this video, you're interested in breaking into private equity, you probably know that you first need to break into banking first. And if that's you, I have two great free resources. One is my 15-part email newsletter with all my best advice from leading JP Morgan recruiting. And another is a quiz I built powered by AI that you can take to see your chances of breaking into banking. I'll leave links for both of these in this video's description. Thanks as always for watching. And if you want more videos like this, check out my last one on the most hated hedge fund on Main Street, Citadel.